Welcome to Bunnex Investment Group ICT YouTube course. Firstly, would love to give credit to the owner and the one who compiled the method that we've just dissected and simplified for you. This is going to be only a 10 lecture course that will provide you everything you need to start trading the ICT method. So basically, if you go to the ICT channel, there are a ton of videos and very long educational videos, which we've tried to actually simplify and make it very streamlined for you. Make sure you subscribe to the channel so that you will be notified each and every time we upload a new lecture. Here is the course content for this streamlined ICT YouTube course. First lecture is going to be Fair Value Gaps Simplified. Lecture 2, Internal and External Liquidity. Lecture 3, The Power of 3 Concept. Lecture 4, Entry Timing ICT Model. Then Lecture 5, Mitigated and Unmitigated Point of Market Interest. Lecture 6, ICT Silver Bullet Model. From Lecture 6 to Lecture 10, there will be models, entry models, and trading models. Lecture 7, Unicorn Model. Lecture 8, Market Maker Model. Lecture 9, Turtle Soup. And last but not least, the Judas Swing Model. So make sure you are part of this channel so that you watch each and every lecture. And if you are new to this course or this channel, please make sure you check out our homepage where there is a playlist for all these course lectures. Firstly, before we talk about anything, as we've said on course outline, we are going to start on fair value gaps, which we are going to simplify. But before we do so, we have a free Telegram channel, which you can check out in the description box below. Firstly, what are fair value gaps? Fair value gaps, or FVGs in short, are gaps created within the market flow. When the market is trending to the upside or is trending to the downside, it usually creates open points where the market has imbalances. They occur when price moves too quickly, thus leaving market imbalances. So when market imbalances are left behind, usually the market will come to balance them off. So take a fair value gap as a point whereby the market couldn't actually place its orders and it actually made some sort of a jump without filling those particular gaps, and the market usually comes back to actually fill those orders or balance those orders. So here's the illustration of FVG. So for a fair value gap to be valid or to be there, we need 3 candles. When the high of a candle fails to fill the gap to the low of the candle after a fast move, an FVG will be formed. In this particular case, we have candle 1, we have candle 2, and candle 3. 3 candles in this line. This first candle is its high, which is the upper part or the top part of its wick. And then candle 2 was issued. Then on candle 3, there is the lowest part of its or the low of this particular candle. So when the upper part of candle 1 fails to intersect or to interact within the space of the low of candle 3, we say this particular gap a fair value gap. Therefore, this is an imbalance within the system. Some people love to call fancy names like buy side, sell side, inefficient, what. But that's not necessary. What is necessary is for you to be able to actually locate these particular gaps within market flow so that you can anticipate to make entries as the market retests those points later. So basically, this particular topic is actually saying, talking of fair value gaps. What are fair value gaps and how do we actually make use of those fair value gaps? Let's now go into detail on charts so that we can actually see where we actually can make entries within these fair value gaps, as well as how do we actually validate these particular fair value gaps. Sit back and let's jump to the charts. Check out our 7-figure traders program, a program dedicated for you to become a high performance trader, only going for $115 per month with trading signals included. Find the link in the description box below and join the winners. To illustrate the concept of fair value gaps, we are going to use gold against US dollar, one of the most traded assets, one of the most beloved by traders. However, if you do not know how to trade gold properly, you will actually lose a lot of money. However, this concept will actually give you an ability to go a little bit closer to your goals of making profit trading gold. So the first thing that we are going to say on fair value gaps is to validate a fair value gap. The first thing that should happen or that should occur is what we call break of market structure. By break of market structure, it's basically a break of the high of the previous flow or break of the low of the previous flow. If we are going to illustrate, we are saying the market should actually create a high, then that high must be broken like this. If we break market structure, we now have evidence of a particular trend. When this happens, the next thing is now to see a fair value gap in the structure that has broken the previous high. In this particular case, we would expect to see the market come to retest a fair value gap within the structure that has broken the high. Let's say this becomes our fair value gap. We would need to actually see the market actually come within that zone and continue the trend. So basically, this is how we are going to illustrate it on the charts so that we can as well apply it. So on the charts, we can see the first thing in this particular case is gold made this high. After making that particular high, it broke structure. After breaking structure, we've said we start to actually we start to inspect for a fair value gap from the bottom part of the move to the upper part of the move. We can see that the bottom part is actually this part, right? And then the upper part of the move is this part. So we need to find a fair value gap within this particular flow. And looking closely, we can see that we had this high actually interacted with that high. There was no fair value gap. This high interacted with that high. There was no fair value gap. But this high and the low of this candle did not interact together. Therefore, if we are to mark, we can see something like this. Within that, we can see the market actually came back to retest or interacted with the middle point of this particular fair value gap, created a candlestick reversal pattern, which you can refine more by going to lower time frames. Therefore, we were going to make an entry to go to the upside from that particular point. The market went to the upside, and after going to the upside, we can now say it broke structure at this particular point. We've said when the market breaks structure, we need to see or we anticipate a retracement to the newly created fair value gap. Starting from this particular point, going to this particular point, we can start to inspect again for a fair value gap. In this particular case, we can see that all the candlesticks were actually interacting the highs and lows. Therefore, the only fair value gap that we can see is this high of this hammer and this low of this particular candlestick. They did not interact, meaning that we had a fair value gap at this particular point. Therefore, this was going to be our fair value gap. We validate at the 50% of the fair value gap like that. Moreover, we can as well concrete the strength of our fair value gaps by actually having a support or resistance in the previous move. In this case, we can see there was actually a support that was turned into actually a resistance that was turned into a support, and actually coinciding with the 50% of our fair value gap, meaning that this was actually a point of entry to go to the upside like that. After that, we can see there was another break of market structure here, then a move to the upside. We now inspect again to see if there was a candlestick or a fair value gap. We can see there was this high and this low did not interact, meaning that we had a fair value gap of this manner. Within that fair value gap, there was also a resistance that turned into support later, and this was another point of market entry. Going to the upside again, we can now see that the market was still creating points of market entry, and now let's check on the sell side of the market structure. On the sell side of the market structure, we had a break of this low, meaning that there was breaking of market structure. Inspecting this flow, we can now see that there was this low and this high did not interact, making this a fair value gap, and the market came to that particular fair value gap, created a candlestick reversal pattern, and went to the downside like that. Then from there, we can see another break of market structure. Let me remove another break of market structure that occurred at this particular point. The market broke structure here, and then the next thing is now to inspect for a fair value gap within this particular flow. We can see that we had this, and the market went to the downside. If the market breaks structure here, we can start again to inspect for a fair value gap within the flow that would have been issued. A flow of this manner, like this, and we would want to see the market pull back again to the fair value gap. Unfortunately, when the market does 3 impulse in one direction, usually the market will change its direction. This is what we will teach in the 7-figure program in our for our private students. On that note, we've come to the end of our first lecture, and with that, we'll see you in the next one. Make sure to subscribe, and see you. Have a blessed day.